Hey, it's Mike from Savvy Nomad. If you're an American living abroad, there's a pretty good chance you've heard the acronym FATCA, and if you haven't heard it, then you really should know what it is. This law is the reason why banking for Americans abroad is so difficult, and it's the reason why US expats must report their foreign assets. Failing to follow FATCA reporting requirements can result in huge penalties. We're talking thousands of dollars. So you don't want to miss this video. Let's dive in. The Foreign Account Tax Compliance Act, better known as FATCA, was passed in 2010 as part of the HIRE Act. It was introduced in response to the major scandal that involved Swiss banks and Americans hiding assets offshore. The goal was to combat financial fraud by forcing more transparency around foreign financial accounts held by U.S. taxpayers. In practice, FATCA dramatically expanded reporting requirements for Americans abroad and permanently altered how foreign banks deal with their U.S. clients. At its core, FATCA requires U.S. taxpayers to report certain foreign financial assets once their total value exceeds certain thresholds. For single filers living abroad, the threshold is $200,000 at the end of the year or $300,000 at any point during the year. For married couples filing jointly while living abroad, the thresholds increase to $400,000 at year end or $600,000 at any given time. This obligation applies regardless of where you live. If you are a U.S. citizen or green card holder, the IRS expects disclosure of qualifying foreign accounts and investments, even if all your income is earned and taxed abroad. Non-compliance can result in significant penalties, even in cases where no additional U.S. tax is owed, and we'll get into that in just a second. Taxpayers who exceed these thresholds must file IRS Form 8938 with their annual tax return. This form requires detailed disclosure of foreign financial assets, including foreign bank and brokerage accounts, pensions, foreign issued life insurance policies with cash value, and interests in foreign entities. And we're talking businesses, anything like that. Now, the US government, they really don't like it when you fail to report your foreign accounts. In fact, if you don't follow the rules, they're going to hit you right where it hurts the most, your wallet. Failure to file Form 8938 carries an automatic $10,000 penalty with additional penalties of up to $50,000 if noncompliance continues after the IRS notification. Now, one of the most common areas of confusion is the overlap between FATCA and the report of foreign bank and financial accounts, better known as FBAR. The FBAR requires reporting of foreign financial accounts once their combined value exceeds $10,000 at any point during the year, and this is filed separately with FinCEN. FATCA reporting is done on Form 8938 and uses higher thresholds, so that's the main difference. Filing one does not satisfy the requirements of the other, and many expats, you're going to have to file both of these. It is also important to understand what FATCA does and does not cover. Reportable assets include foreign bank and investment accounts, foreign pensions, foreign issued life insurance policies with cash value, and ownership interest in foreign entities such as a business. Assets that are not reportable include foreign real estate held directly, personal property like vehicles or jewelry, and cash held outside of a financial institution. Now, it's important to keep in mind, FATCA does not stop at the individual level. Banks, investment firms, insurers outside the United States, they're also required to collect tax information, identification numbers, and report foreign account details to the IRS. Institutions that fail to comply face a 30% withholding tax on U.S. source payments, including interest, dividends, and proceeds from U.S. securities. So this is a big deal to a lot of banks. This is the main reason why banking abroad has become such a big pain in the butt for Americans. A lot of banks, they've simply decided that we're too much trouble and they don't want to open an account with us at all. Now, there are a number of Swiss banks with US branches that are accustomed to dealing with FATCA reporting requirements. We talked about some good ones a while back on this channel, so go check out the rest of our content. So bottom line here, understanding how FATCA works and what you're required to report is essential for avoiding penalties and maintaining financial stability while you're living the dream life abroad. It goes without saying, FATCA rules are complex and highly specific to each individual. Quick disclaimer, this video is for general educational purposes only. Savvy Nomad does not provide legal, tax, or investment advice. Anyone with foreign financial assets should review their situation carefully with a qualified professional before making any decisions. Now, if you enjoyed this video and you want to sink your teeth into some great bedtime reading material, go download our 2026 Expat Tax Guide. We have over 40 pages of material on optimizing your tax situation if you're a nomad or an expat living overseas. So go check that out. It's free for subscribers to our email list. Also, make sure to follow our channel. And if you didn't do it already, hit that like button. It just really helps us out in the algorithm so we can get this content to more people who really need to see it. Until next video, safe travels and happy tax planning.